Today, we're going to talk about one of the coolest things in investing, how you can literally get paid by major companies just for owning a piece of them. It's a super powerful concept called dividends, and we're about to break down exactly what they are, how they work, and how you can use them to build some serious wealth.
So we all know the classic way to make money with stocks, right? You buy low and you hope to sell high. But what if I told you there's another way? A way for your stocks to generate a steady stream of income, all without you ever having to hit that sell button. Well, that is the incredible power of dividends.
So what exactly is a dividend? The easiest way to think about it is as a company's way of saying, hey, thanks for being an owner. When a company makes a profit, it has a choice. It can pour that money back into the business to grow, or it can share a piece of that profit directly with its shareholders. And that piece of the pie they share, that's the dividend.
The whole idea is actually pretty simple. Imagine a company's total profits are one big pizza. A dividend is just the board of directors deciding to cut a slice and hand it directly to you, the shareholder. You can get these payments from individual stocks you own, or even through things like mutual funds and ETFs that hold dividend-paying stocks.
But as soon as there's income, we have to talk about taxes. And with dividends, it gets really interesting because not all of them are treated the same way by the tax man. Understanding this difference is absolutely crucial because it directly affects how much of that profit you actually get to pocket.
So there are two main types you need to know about: ordinary and qualified. Ordinary dividends are taxed at your regular income rate, the same high rate as your job. But qualified dividends, these are the ones you really want. They get special treatment and are taxed at the much lower long-term capital gains rate. And trust me, that can mean a huge tax savings for you.
So what's the secret to making a dividend qualified?
Well, there are two main rules. First, it has to be paid by a U.S. company or a qualified foreign one. And second, you can't just buy the stock a day before the dividend and sell it the day after. The IRS is wise to that. They require you to hold the stock for a certain period, usually more than 60 days. Now, it sounds a little technical, I know, but here's the best part. Your brokerage firm tracks all of this for you automatically. When tax time comes, this all gets simplified for you on one single form, the 1099 DIV. Your brokerage sends it to you. You'll see your total dividends in box 1A, but the number you're really looking for, the golden number, is in box 1B. That tells you exactly how much of your dividends got that sweet, lower, qualified tax rate. All right, so a dividend payment just hit your account. Cha-ching! Now you've got a really important choice to make. Do you take that cash and spend it, or do you put that money right back to work? This decision is really at the heart of building serious long-term wealth. This brings us to an incredibly powerful, totally automated tool called a Dividend Reinvestment Plan, or DRIP for short. Pretty much every brokerage offers this. When you turn it on, it takes your dividend payments, and without you ever lifting a finger, it automatically uses them to buy more shares of that exact same stock. The choice is totally yours. Taking the cash gives you immediate income, which can be fantastic, especially if you're in retirement. But reinvesting through a DRIP, well, that's how you unleash the absolute magic of compounding. Your new shares start earning their own dividends, which then buy even more shares, creating this incredible snowball of growth over time.
Let's just watch this in action. Imagine you start with 100 shares of a company. They pay out a dividend, and because you smartly enrolled in their DRIP, that cash is automatically used to purchase 2 more shares for you. And one of the coolest features here is that DRIPs can buy fractional shares. That means every single penny is put to work, and usually there are no commission fees. So now, look at that, you own 102 shares. The next time a dividend gets paid, it's going to be based on your new, larger share count. That means you get a bigger dividend payment, which in turn buys even more shares. This right here is the simple, beautiful engine of compounding. This compounding effect is amazing, but it only works if the company can actually keep paying the dividend. And that leads us to a really critical question for any investor. How in the world do you know if a dividend is safe? One of the best tools for this is the dividend payout ratio. It sounds fancy, but it's just a simple percentage that tells you how much of a company's profits are being sent back to shareholders. Think of it as a quick health check for the dividend. Now, there isn't one single perfect ratio. It really depends on the company. A young, fast-growing tech company might have a low payout ratio because it's plowing all its profits back into growing the business. But a mature, stable utility company might have a high ratio because its job is to return its steady cash flow to investors. The one big red flag for any company, though, is a ratio over 100%. That means it's paying out more than it's earning. And that, my friends, is just not sustainable.
Now, it's important to remember that dividends aren't the only way a company can return cash to you. There's another major method that has become even more popular in recent years, the stock buyback.
So instead of sending you a dividend check, a company can use its profits to buy back its own stock from the market. This reduces the number of shares out there, which makes each remaining share a slightly larger piece of the company pie. A lot of companies prefer buybacks because they're more flexible, and for a long time they were more tax efficient, though now they are subject to a small 1% tax in the US.
So let's wrap this all up with the key things you need to remember. 1. Dividends are your share of the profits. 2. Always look for those qualified dividends to save big on taxes. 3. Use a drip to put the incredible power of compounding on autopilot. And 4. Always check that payout ratio to gauge a dividend's health.
And that's our rundown of dividends. We've covered what they are, how they're taxed, and how you can use them to grow your portfolio. You now have the essential tools to make them a part of your financial future. The only question left is, how are you going to put them to work?